Joining us now in a CNBC exclusive for more, Donald Kohn, former vice chair of the Federal Reserve. So much to talk to you about today. Nice to have you here.
Nice to be here, Sarah.
So does the announcement of new tariffs on the remaining $300 billion of Chinese imports change the calculus or the trajectory of the Fed this year?
Well, it certainly could. It will increase inflation a bit here, as we've been hearing. It'll raise prices for consumers, so it hurts households. But the uncertainty about trade and trade tensions was one of the things that Jay Powell pointed to yesterday as a downside risk to the U.S. economy. And I think this escalates the trade tensions, increases uncertainty, will be hard for businesses to figure out where their capital spending should be. So this is not good for the U.S. economy. If it leads to a good agreement and a stand down and a truce, that'll be great. But meanwhile, it certainly is not good for the economy, and it's understandable why the stock market and the bond market has reacted the way it has.
Donald, are interest rate cuts a good cure to the trade war and to broader global macroeconomic weakness?
Well, interest rate cuts, of course, by themselves will have no effect on the trade war. But I always thought of myself as a monetary policy maker as providing some cushions and offsets to shocks that came from other places, even though my increase or decrease in interest rates didn't directly address those problems. At least it helped the U.S. economy be resilient to those problems. So I think if this persists and the adverse effects on the equity markets, on business confidence, on household confidence rise with this, then I think a further cut in interest rates will be very much on the table to help the economy in other ways.
Were you on board with the interest rate cut of yesterday?
Yes, I was. I thought the Fed ended up about where it should. That is a quarter-point cut and a bias towards ease, but not a firm commitment about where it was going from here. The data that they had over the intermeeting period, if anything, was strong, right? Retail sales, employment, strong. The big important pieces of data, if anything, were stronger than expected. But I think the risk management aspects ring true to me. The likelihood of bad things happening was greater than the likelihood of good things happening, particularly in the global dimensions, as we're seeing today. Inflation below path and below target, and perhaps coming up, but not convincing evidence yet that it was on its way up. In a situation like this, it seemed to me there was very little cost to lowering interest rates, and perhaps some gain, as I say, cushioning the economy against these other effects.
Donald, should the Fed chair be better at communicating his message by now?
I think the Fed chair has done good communication in some respects, but there's room for improvement, as my grade school report cards used to say every 6 weeks. I think I like the way that Chairman Powell tries to express things in plainer language that people can understand. But I think in a rapidly changing situation, there are nuances and risks that could be expressed better than he has expressed them. And the fact that markets have reacted, that there's been a pivot over this year, I think suggests that there's always room for improvement. But I want to add here that this communication is very, very difficult. And a difference between the Fed and the market as to what is expected is not at all unusual, and it's existed over many chairs. So this is by no means an easy task, and it always requires, you can always work at it, doing it better.